$65 billion erased in a matter of days. By March 2023, one bank, widely trusted by the tech industry, was collapsing in real time. Just weeks earlier, depositors believed their money was safe. Analysts still called it stable. Management projected confidence. Then the withdrawals started, and within 48 hours, Silicon Valley Bank was gone. So what really happened? To understand the real economic threat, you have to look beyond inflation headlines and focus on something far more fragile: trust inside the financial system. March 2023, regional bank stocks across the United States began to fall sharply. This wasn't driven by inflation data. It wasn't about long-term economic cycles. It was immediate. Liquidity risk. According to regulatory filings and market data, billions of dollars in deposits began moving out of certain banks within days, not weeks, not months, days. This wasn't a slow crisis. It was a sudden shift in confidence, and that shift exposed a deeper vulnerability in the system. Here's where things begin to change. For years, banks operated in a low interest rate environment. Deposits increased, lending expanded, investment portfolios grew. On the surface, everything looked stable, but underneath, something was quietly building. Think of it like this. A bank takes your deposit. It doesn't just hold it, it invests it, often into long-term assets like government bonds or mortgage-backed securities. These are considered safe, but they are sensitive to interest rates. Now imagine this. A bank locks your money into a long-term bond paying 2%. Then interest rates jump to 5%. Suddenly, no one wants that old 2% bond, so its market value drops, not because it's unsafe, but because it's outdated. And in 2022, interest rates didn't just rise, they surged. According to data from the Federal Reserve, rates increased at the fastest pace in decades. That shift changed everything. Assets that looked stable on paper were now worth less in the market. Not due to default risk, but because the environment changed. Now here's the key question. Does that matter if a bank holds those assets long-term? Normally, no. But only if depositors stay. And that's where the real threat begins. Banks depend on confidence. If people believe their money is safe, they leave it in place. If that belief changes, behavior changes. And in today's system, behavior changes fast. No lines, no waiting, just digital transfers. According to public reporting, some institutions experienced tens of billions in withdrawal requests within a single day. That speed matters. Because banking stability was built on a simple assumption. Not everyone withdraws money at the same time, for decades. That assumption held, but technology changed that. Now money moves instantly, and time is everything. Let's go deeper into the illusion of stability. Many of these banks appeared strong. Capital ratios were within limits. Loan portfolios were not collapsing. Earnings were still positive. So why did confidence break? Because markets were not focused on credit risk, they were focused on liquidity. Credit risk asks, will borrowers repay? Liquidity risk asks, can the bank return deposits when asked? And in a digital system, liquidity risk moves faster, much faster. Here's the turning point. When one institution shows stress, others get examined. Investors and depositors begin comparing. They look for patterns: high uninsured deposits, concentrated clients, large unrealized losses. Once those signals appear, behavior shifts. Not gradually, instantly, according to regulatory statements. Uninsured deposits played a central role. These are deposits above the insured limit. They are not guaranteed in the same way. But here's what matters more. Many of these accounts were companies, startups, venture firms, payroll accounts. If that money was frozen, employees wouldn't get paid. Operations would stop. So waiting wasn't an option. Moving first was survival. And that changes everything. One withdrawal triggers another, then another. And soon the system isn't reacting to fundamentals. It's reacting to momentum. This is where inflation becomes less relevant. Inflation is slow. It develops over time. What happened here was different. It was immediate, behavioral, driven by perception, and perception moves faster than policy. Now, consider the structure. During years of low rates, banks were incentivized to grow. More deposits meant more lending. More lending meant more earnings. Holding long-term assets increased yield. Each step made sense. Individually, but together, they created exposure. When rates rose, asset values dropped. When confidence shifted, deposits moved. When both happened at the same time, pressure intensified. This is not about one bank, it is about a system dynamic. According to regulatory reviews, multiple institutions faced similar pressures. Some stabilized, others didn't. The difference often came down to one factor: speed. Speed of outflows and ability to respond. Because in modern finance, survival isn't just about assets, it's about timing, and timing is shrinking. So here's the real question. If confidence can disappear in days, if billions can move in hours, and if balance sheets are exposed to interest rate shifts, then what exactly is the real economic threat? It's not inflation alone. It's the combination of liquidity, technology, and human behavior. And we are just beginning to understand how those forces interact. The real problem was not hidden. It was structural. By early March 2023, the conditions were already in place. Interest rates had risen sharply, bond values had fallen across the system. That part was understood. But what markets underestimated was speed. How quickly those losses could turn into a liquidity crisis. Here's how the mechanism actually worked. Banks took in deposits during a low interest rate environment. Those deposits were large, stable, growing. To generate returns, banks invested that money into long-term assets, government bonds, mortgage-backed securities. These were considered safe, low default risk, but they carried one critical exposure: interest rate risk. When rates rise, bond values fall. That's the starting point. Now, under normal conditions, this is manageable. Banks don't need to sell those assets immediately. They can hold them until maturity. On paper, losses remain unrealized, so everything looks stable. But that stability depends on one thing: deposits staying in place. Once that changes, everything changes. Let's connect the chain. Step 1. Interest rates rise rapidly. Step 2. Bond values decline. Step 3. Unrealized losses grow on bank balance sheets. Step 4. Confidence begins to weaken. Now here's where it accelerates. Large depositors begin reassessing risk, not just in one bank, across multiple institutions. They compare balance sheets, they look for signals: high uninsured deposits, industry concentration, exposure to declining assets. Once those signals align, decisions follow. According to public reporting and regulatory disclosures, some banks experienced withdrawal requests in the tens of billions within a single day. That scale changes the equation, because liquidity is limited. Banks don't hold all deposits in cash. They keep a portion liquid. The rest is invested. So when withdrawals exceed expectations, the system is forced to react. Now the bank has 3 options. Option 1, sell assets, but that locks in losses immediately. Option 2, borrow money, but that requires collateral and market confidence. Option 3, access emergency liquidity, but that takes time and time. It's exactly what they didn't have. So the situation becomes a race. Outflows versus available liquidity, and in a digital system, outflows move faster. Here's the turning point. Once a bank is forced to sell assets at a loss, those losses become real, not theoretical. That weakens capital. And once capital is questioned, confidence drops further. This creates a loop. Withdrawals increase. Assets are sold. Losses are realized. Confidence declines. More withdrawals follow. Now layer in behavior. Because this wasn't just about numbers, it was about decisions. Many of the largest depositors were not individuals. They were companies, venture capital firms, technology startups, funds managing payroll. If that money became inaccessible, they couldn't pay employees, they couldn't operate. So their decision wasn't optional, it was immediate. Move first, protect liquidity. This is what amplified the outflows. Now add another factor: information speed. In previous decades, bank stress unfolded slowly. Today, it spreads instantly. Financial data updates in real time. Investor commentary circulates within minutes. And communication networks amplify everything, according to public accounts of the period. Concerns about specific institutions spread rapidly across investor groups and digital platforms. Not necessarily new facts, but faster interpretation. That distinction matters. Markets react to expectations, not just data. Now consider decision-making inside banks. Management teams had to respond in real time. Some attempted to raise capital. Others tried to reassure depositors. Some accessed liquidity facilities, but response speed varied, and in this environment, delay is risk. Regulators were also monitoring the situation. According to statements from the Federal Reserve and the FDIC, liquidity conditions were being assessed continuously. But here's the constraint. Intervention requires thresholds, and by the time those thresholds are reached, outflows may already be accelerating. This is what makes liquidity crises different. A bank can appear solvent. Assets may exceed liabilities, but if it cannot meet short-term withdrawals, it fails. That's the distinction. Solvency versus liquidity. And in March 2023, liquidity moved faster. Now add one more layer: uninsured deposits. According to regulatory disclosures after the event, some institutions had a high percentage of deposits above the insured limit. These depositors behave differently. They monitor risk closely. They react faster. They move larger amounts. So when uncertainty appears, their response is immediate. That amplifies pressure. Now combine everything: rising rates, falling asset values, high uninsured deposits, instant digital withdrawals, rapid information flow. The system becomes highly sensitive. Small changes in perception trigger large financial movements. That's the mechanism, not fraud, not hidden transactions, but a structural vulnerability built into modern banking. And here's the critical insight. This didn't require one catastrophic mistake. It came from a series of rational decisions. Banks pursued growth. They invested in safe assets. They expanded deposits. Each step made sense, individually. Exposure to a change in environment. And when that change came, it came fast. Now the question becomes unavoidable. If stability depends on confidence, and confidence can shift in hours, then how resilient is the system under stress? Because by mid-March 2023, the answer was already unfolding. March 12, 2023. By the time markets prepared to open on Monday morning, the outcome was already decided. Silicon Valley Bank had been shut down by regulators. Within days, a bank holding tens of billions in deposits had lost enough liquidity to fail. According to regulatory statements, the scale and speed of withdrawals made continued operation unsustainable. The system had crossed a threshold, and once that threshold was crossed, intervention was immediate. The Federal Deposit Insurance Corporation stepped in as receiver. A bridge bank was created. Operations continued. Depositors were given access to their funds, including those above the insured limit. That decision was critical. Under normal conditions, deposit insurance covers balances up to a fixed threshold. Amounts above that limit carry risk. But this time, regulators made an exception, according to joint statements from the U.S. Treasury, the Federal Reserve, and the FDIC. All depositors would be protected under a systemic risk exception. That move was not routine. It was designed to stop something larger: contagion, because by that point, the issue was no longer isolated. Other regional banks were already under pressure. Stock prices were falling, depositors were reassessing exposure, confidence was spreading. In reverse, but while regulators were drafting official statements, something else was happening in real time. Founders were messaging each other. Investors were calling emergency meetings. Finance teams were refreshing account dashboards. One question kept repeating: is the money still there? Because by that moment, no one was waiting for confirmation. Decisions were already being made. This is what a modern bank run looks like. Not lines outside branches, but digital movement, silent, fast, irreversible. Now, consider what actually caused the collapse. It wasn't a wave of loan defaults. It wasn't toxic assets. It was liquidity. A rapid withdrawal of deposits that outpaced the bank's ability to respond. And that distinction matters. Because liquidity crises behave differently. They move faster. They escalate without warning, and they are harder to contain once momentum builds. Now look at the system response. In the days following the collapse, the Federal Reserve introduced new liquidity measures. According to official announcements, banks were given access to funding facilities that allowed them to borrow against high-quality assets, even if those assets had declined in market value. The objective was clear: prevent forced selling, stabilize balance sheets, restore confidence. At the same time, regulators increased monitoring across the banking system. Focus shifted toward key risk areas: liquidity buffers, uninsured deposits, interest rate exposure. According to congressional testimony and regulatory reviews, These factors became central to post-crisis analysis. Now, step back. What did this event actually reveal? First, size does not guarantee stability. Some of the affected institutions held tens of billions in assets, but size didn't prevent rapid failure. Second, liquidity risk moves faster than traditional models assume. Stress scenarios often simulate gradual pressure. This was not gradual. It unfolded over days. Third, uninsured deposits change behavior. These depositors act quickly, they move large amounts, and their actions influence the system. Fourth, technology has redefined banking speed. Withdrawals that once took days now take minutes. Information that once spread slowly now moves instantly. And that changes everything. Because when speed increases, reaction time decreases. Now, consider the implications. If deposits can move instantly, banks must hold more liquidity. If confidence can shift rapidly, regulators must monitor behavior in real time. If information spreads without delay, markets react before policy can respond. This is a different system, one where stability is conditional, not assumed. Now, return to the original question. Forget inflation. This is the real economic threat. Not because inflation doesn't matter, but because inflation is slow. It builds over time. It can be managed. Liquidity crises are different. They are immediate. They are behavioral. And once they begin, they move faster than intervention. Here's the deeper layer. Most people don't think about bank balance sheets. They assume access, they assume stability, they assume continuity, and most of the time, those assumptions hold. But March 2023 showed something else. It showed that under certain conditions, those assumptions can be tested, not over years, but over a weekend. Now, consider this. The same system that allowed billions to move out of one bank exists across the entire financial network. Digital access, instant transfers, real-time information. These are not isolated features. They are the foundation of modern banking, which means the vulnerability is not isolated either. It is systemic. So the question is no longer whether the system works. It does. The question is how it behaves. Under pressure, because when confidence shifts, everything else follows. Liquidity, speed, behavior. These are now the defining forces of financial stability, and they operate faster than most people expect. If you value clear, fact-based analysis of financial risk and how modern systems behave under stress, consider subscribing the channel for future breakdowns, because understanding the system is no longer optional. It's necessary.